Welcome to Impact Farming, where we introduce you to the people and ideas that will have a massive impact on your farming operation. Brought to you by Farm Marketer. Sit down, start the engine, and let's roll with today's show.
Hello everybody, welcome to today's show. We are at Ag in Motion, live on location 2018. And today I have with me a very special guest. I've been looking forward to this. It's Dean Klippenstine with Myers Norris Penny. And Dean is a business advisor for the agriculture sector of Myers Norris Penny, correct?
That's correct.
Okay. Dean is here to join us and discuss incorporation. So, Dean, can you tell us a little bit about your role with Myers Norris Penny, and then we can move into talking about incorporation?
Yeah, thanks very much. My role at M&P is really around advising people in the agricultural space. And when we talk about agriculture and M&P, we talk about primary producers on the ground, growing the crops, growing the animals. We're not talking about the secondary ag sector like our friends at Meridian, where we're at today.
Perfect. Okay, so you're working with farmers and you are taking care of all the accounting needs of their business and making sure that that sector of their business is healthy.
Yeah, we focus on a team effort and we have a large group of people focusing on getting the compliance work done, financial statements, tax returns. But then there's a sector that assists them in achieving their big picture goals and helping them guide and achieve whatever goals and objectives they have, whether it's retire by 40, whether it's pass on a legacy farm, and we're there to give business advice around those goals and objectives to the best of our ability.
Excellent. And you guys are a big team right across Canada, right?
Yeah, there's about 700 members in the ag team who focus on dealing with the vast majority of their time focused entirely on dealing with hands-on ag producers.
Perfect. So what I really want to talk to you about today is incorporating. This is a tool many are aware of, but I find many primary producers are still not aware of the benefits of incorporating the farm. Can you give me a brief description of why a farmer would want to incorporate?
Well, I'll maybe talk about the disadvantages first and dispel some of the myths that are out there. It is a little more expensive. With the compliance work required around a limited company, there's a little more legal, there's a little more accounting. One of the things that I always find frustrating, people talk about it being a negative of incorporation, is that you have to prepare accrual financial statements. Well, as a former producer myself, I don't view that as a negative, and even our farms that are not incorporated and do not need it for tax, we still strongly encourage them to prepare a financial statement for their farm operation so they understand their profitability.
Absolutely.
So the other negative they talk about is that on liquidation of the farm, the corporate farm does not receive capital gains deduction. Whereas an individual farm does. The issue though is that if I were to sell the shares of my farm company, I still qualify for the capital gains deduction. And more importantly is in many of these farm situations, the goal is to pass it on to the next generation.
Absolutely.
And so we'll go into a little more detail later about how much capital gets preserved in these limited farm companies. And that's really, when you sum it down into one sentence, it's to preserve capital to store in your business rather than storing in unproductive assets like tax or not utilizing your cash to the ability, to your full ability.
So that is some of the disadvantages, and you look around, you try and do a little bit of research on incorporating, and that tends to pop up, and I'm glad you started there. You know what, that's a good basis. Now, I'd love for you to touch on the reasons why a farm would want to incorporate.
The only reason there's two key purposes for incorporating. One is legal limited liability. If I'm a shareholder in a limited company and they get sued or go bankrupt, I don't get personally sued or bankrupt. So asset protection and limited liability on lawsuits. Not really significant in the ag community as of today. Maybe in the future it's more significant, but certainly it's not a primary reason for incorporating in our client group.
Okay.
The second and main reason is that it allows for a deferral of taxation until that money's pulled out personally.
Right.
And there's lots of people who come into our office. One of the myths is that, well, my tax bills haven't been substantial, so therefore I don't need to incorporate. And that's reasonable. That's a reasonable comment.
Okay.
What you got to look behind the scenes at is to say, am I forcing myself to hold grain or hold cattle or defer grain checks and starve my operation of cash?
Yeah, absolutely.
While in just under the guise of avoiding tax, because it actually doesn't avoid tax, it just pushes it off into the new year.
Totally.
So as a rule of thumb, you could say your average personal tax rate is 35% plus.
Yeah.
When you include Canada Pension, even the lowest tax rates are 35. The small business tax rate in Canada and Saskatchewan coming up is 12%. So fundamentally, 20% more of your net income can be utilized in your operation. Now, if I said I'm going to make $50,000 a year in my farm, and I'm going to take that $50,000 a year and buy a fishing boat with it, a limited company does me no good.
Okay.
Because when we talk about the deferral of taxation, I'm still going to pay my 35 or 40% tax rate when I use that money personally. For spending, to buy a cabin, to buy a fishing boat, to pay for groceries. But if there's capital required in my farm to buy machinery and buildings and equipment and really, really powerful land and quota, because those are quotas depreciable at a very slow rate, and land is not deductible at all. So any assets I'm pouring into those, I've got if you make $10,000 on your farm and you're corporate, you're going to pay 12% tax and have $88 left to make land payment, $8,800 left to make land payments or purchase land or purchase quota. And on that same $10,000, I've only got $6,000.
Wow.
And so you can see
difference.
how, as those, now obviously if our farms were only going to ever make $10,000, the value of that is eaten up in lawyer and accounting fees.
Right.
So, but I don't, if I was going to echo a couple important points to your producers watching this or listening to this on podcast, what I really want to get through to them is that it's not just what you're being taxed on. What you have to look at is how much you're pushing into next year and hurting your business. Right. Because you're letting someone else use that capital. In the case of a deferred grain check, you're letting the grain company use that capital instead of having it in your operation.
Absolutely.
And so I talked about the differential in tax rates. But the tax rates in Canada, I don't know how many of the producers would know, but they'd have a base understanding that the marginal rates increase as your income gets higher.
Yep.
Fundamentally, the marginal rates in a corporation don't get higher until $500,000 net income. Okay. So there's a lot more capacity.
That's a big difference.
It is a substantial difference. So if I had a producer phone me in their personal, and they're taxable at $50,000, and they ask me, should I defer a grain check? I say, probably we should. A corporate producer, I say, well, no, you're better off taking that money, paying 12%, and using that money in your own operation to pay down debt, to buy land, to reinvest, because that is value added to your business. Absolutely. And so that's really important, because lots of advisors, good, well-meaning advisors, look at someone's tax return and say, well, you're taxable in $60,000, you don't need to have a limited company. That's true, but you got to peel it back to look at the layer that we're pushing into next year.
What's the producer actually doing, right?
What's the producer doing?
Okay.
Because as a rule of thumb, we're starving our businesses of cash to try to avoid tax.
And it doesn't help, because it just gets you next year anyways, right?
It just kicks the can down the road.
Yeah.
So, limited company, I can have the freedom to pay up to $500,000 at low rate and really, really feel the benefit. We have lots of producers who say, well, we used to talk about all the tax savings, and then what we realized as we became more experienced in this is producers were then, when they first incorporated, realizing that tidal wave of income coming behind them.
Okay.
So this, a forewarning, if you incorporate, your tax bill's probably going to be higher than it ever was personally, because you're letting this flow of income come in and not pushing it off to next year.
Right. That would be the big difference.
Yes. That is the fundamental difference.
Okay.
Because if you thought about our asset pool in two buckets, and you thought about two simple buckets, I've got a bucket of cash and I've got a bucket of land.
Okay.
In order for me to buy more land, I've got to go through a tax wall.
Yeah.
And it's just, I'd rather go through that tax wall at 12% or whatever it is in your province than go through it at 40.
That's unbelievable. When you look at a tax rate of 35-40 to the provincial tax rate for personal, 20% more, give or take.
At a minimum.
At a minimum, left to spend. Just think what you could do with that 20% and what that, well, I mean, that can affect generations. That can buy you 20% more land. Whatever you want to do, right?
I've got some stats I'll pull out. I don't remember them off the top of my head, but an example of, well, I'll pull them out right now. But in order to buy $1 million of farmland, which, as crazy as it sounds, does not buy near as significant amount of land as it used to.
No.
10, 15, 20 years ago. And what do we pause? We'll find that.
Okay, so Dean and I were just crunching some numbers, and he brought us some facts and figures when buying land, the difference in taxation rates, right?
So I always find farmers talk best, grain farmers talk best in bushels.
Okay.
And so what I've done is I've put the comparison in order to buy $1 million of land.
Okay.
In bushels, I need 90,000 bushels of canola.
Excellent.
$11.
Okay.
In order to have 90,000 bushels of profit after tax, I've got to grow 165,000 bushels of canola profit.
Okay.
So over and above all my expenses.
Yeah.
Then I'm going to send 75,000 bushels to Ottawa personally.
Okay.
And I'm going to have 90,000 bushels left to purchase land.
Okay.
For $1 million.
Okay.
In that same comparison, it takes 103,000 bushels of canola.
Okay.
And I'm going to send 13,000 bushels to Ottawa.
Okay.
To have 90,000 bushels left over.
Okay.
To buy the same amount of land.
Wow.
So that's about 62,000 bushels of canola difference.
That's a lot of bushels, pardon me.
And now, obviously, that changes how a small farm, it's going to take a lot of years to generate 103,000 bushels of canola. And a larger farm, it would take not as many, hopefully.
Right.
But however long it takes your farm to produce that many bushels of canola. So again, if you and I were comparing and you were growing canola corporately, every 100,000 bushels of canola profit, you've created 103.
Okay.
You buy $1 million of land and pay for it.
Okay.
I've got to grow 62,000 more bushels before I just pay for that same $1 million.
That is significant.
It's astounding.
Yeah.
And so I really, it's a passion of mine and been a passion of mine for the last 25 years. We incorporated farms before farm profitability was cool.
Okay.
But it's because these operations, and everyone talks about, well, I've been able to move the tax and not grow my farm and not pay tax.
Okay.
Well, fundamentally, then you have debt on your land or debt on your operating. In order to pay that off, if that's your goal and objective, you need to move it from the grain bucket to pay tax to get it in the form of cash to either buy land or pay down debt.
Right.
And since we're such a land buying breed, that's a really important tool. And just imagine the legacy effect. If your children are going to take over your farm and you've bought land, the first million was paid for with 103,000 bushels, and then you start buying the next million with the next 62.
Yep.
And I'm starving my operation of cash, trying to defer and pre-buy and not use my money and not pay down land, and I got to grow another 62,000 bushels of canola to pay for the same million. It is intergenerational. The effects are intergenerational.
Yeah.
And very significant.
Wow, that's unbelievable. And you know, I'm still, different areas, different producers are familiar with the tool, but I still come in contact with a lot of farmers that in corporation, their eyes sometimes glaze over. They don't know about the tool. They just do not know. And as I mentioned to you, our goal here is to bring Canadian farmers the people and ideas that are going to impact their operation. And I think what you just shared is tremendous.
Well, it's a pretty powerful decision-making tool, and we have lots of clients come into our office and say, my goal is to reduce tax. And I tell them, no, it's not. Your goal is to pay the most enormous tax bill possible.
Okay.
That's our goal and objective.
Yeah.
I mean, I want everyone to remember and clarify that.
Right.
If I've ever went to someone and said, hey, I want to pay you $10,000 more, they've never once said, no, I don't want that because then I'm going to have to pay more tax.
That'd be a little silly. Yeah.
That's right. So our goal and objective is to pay the biggest, largest tax bill we possibly can. We want to do it at the lowest possible rate we can.
There we go.
But in order to get those assets working for your operation, you need to turn it into cash, and that's our goal and objective. Remember, the fundamentals behind this isn't that all farms are bad at business.
No, not at all.
The issue is that no other business has the luxury / detriment of cash basis accounting.
Okay.
So your media company, if you send an invoice for $10,000 for work you've done,
Yep.
you have to pay tax on that regardless of if you've received it yet.
Absolutely.
A farm does not have to pay tax on it till they bill it. So that's the reason we've got in this cycle, our industry, is that, have you ever noticed if you went into your local machinery dealership and wanted to pay a bill, they never said, no, come and pay me in 2 weeks? They say, yeah, that's awesome.
Yep.
They want the money as fast as they can.
Absolutely.
They don't have to pay, they have to pay tax on it whether they've received it or not. Okay. And so it's got a bunch of bad habits developed in our industry.
I see where that started then.
That's where the issue comes from. It's not that farms are bad at business, it's that the rules are different. But we've utilized those rules so far it's actually to our detriment.
Okay.
So that's where some of these historic decisions are coming from.
Interesting. I didn't realize that. Shame on me.
Yeah, no, that's okay.
And that's why we have the experts here sharing the ideas that are going to impact Canadian farmers. So that's a wealth of knowledge right there. If a producer's sitting at home, sitting in the tractor, listening to the podcast, and they're going, well, I'm just too small of a farmer, that doesn't make a lot of sense. Is there a rule of thumb? I know you touched on it a little bit. Is there a farm that's too small to be thinking about incorporating?
Absolutely.
Okay.
If you and your husband lived on an acreage and had 15 cows as a sideline operation, and even significant taxable income from those animals was only going to be X, then it's not worth the pain of going through the accountants and lawyers, because does not occur without cost,
right,
and without pain.
Okay.
But please don't look at it in your historic taxable income.
Okay.
I want you to look at it and say, if I quit the farm tomorrow, how many dollars of taxable income would I have if I sold my machinery and I sold my grain and I sold my livestock?
Oh.
And that number adds up quite significantly pretty quickly.
Absolutely.
And so lots of times we have farms that had not needed to historically incorporate, and we incorporate them just prior to the auction.
I was going to ask about that, because that's another reason, right? That sometimes producers don't incorporate, and then they're coming close to succession planning, selling the whole operation, and that's when that incorporation flag may be raised by the accountant, right?
Well, that's right, and there's a tidal wave of taxable income. So what we often do when we're visiting with the producers, we say, and they say, well, Dean, we're not planning on quitting for 10 years.
Okay.
And I say, okay, well, let's pretend we were going to quit tomorrow. What does our tax position look like?
Okay.
And if the inevitable is that, oh yeah, we're not going to be able to liquidate these assets without being incorporated anyways, then why would we starve our operation for cash for the next decade?
Very
Let's
smart.
incorporate today.
Very smart.
So that's one of the things we look at. And those numbers, no one in the agricultural world, and I guess in all fairness, no entrepreneurs in any regard feel as wealthy as they are.
Right.
So what we do is when we ask them how much their taxable income they'd have, they always underestimate it. We say, okay, write it down.
Okay.
Write down all the stuff you own. And that number adds up to be far more significant than their gut reaction is.
Right.
And so just bringing them in touch with that reality and then the cost-benefit trade-off.
Absolutely. I know on our operation, I do debt to asset income statement, and it's funny, just like you said, you don't realize quite what you own until you get it all on paper and you go, oh, that tractor is worth this, and then you add it up. I can imagine how many farmers are like, it's not going to be a problem, and then come the time that they sell, if they don't make the right decisions, they can have a hefty tax bill at the end, right?
That's right. And so we have farms that are still, with their long-term objectives, incorporation still didn't make sense for them.
Okay.
But even preparing yourself and warning and understanding that tax bill's coming is a valuable asset.
Okay.
Right? Even if we make the decision not to incorporate. Understanding, because many producers, there's been a trainload of producers who never really understood how much tax deferral they had, and then the auction sale comes and they get their tax bill and their natural reaction is, I shouldn't have had my auction sale because I paid it all to tax. No, you didn't pay all the auction sale to tax. Your maximum tax rate is 50% or slightly over.
Okay.
What happened is you had land rent come in.
Oh, yeah.
And deferred grain from the previous year.
Right.
And a rebate check from the fertilizer chemical company.
Okay.
And then an auction sale the following spring and a bunch of other income, and then starting to get interest income. So all that keeps, that literally, I call it a tidal wave.
Yeah.
It's a snowball of taxable income that comes crashing down. And we can trick ourselves into thinking, well, we'll spread it over a couple of years. But once you reach a certain plateau, your tax rate's 40 to 50%, whether I'm taxable on $600,000 or $150,000.
Okay.
It's a really high rate of tax.
Okay.
So those are some of the things we watch for at the tail end of the career.
Okay. So let's speak to the audience here, and if they're sitting and they're just unsure whether or not they should incorporate, is there two parts I'll go into. Is there a great place that you know of to learn about incorporation?
Well,
or is it really you need to sit down with a professional like yourself and go, here's who we are, and then let the professional sift through it all?
Well, that's right. You can learn an awful pile in an hour or 2 hour consultation.
Okay.
Right? If you come into my office, we sit down for a couple hours, and if we decide to work together, great. If not, that's fine too. But and not just M&P. There's other good professionals who work in the ag community, but I would strongly recommend you deal with someone who's working directly with farmers in the ag community.
Yeah.
Because those rules are so different. So a real simple example, if your uncle had a welding shop that made $100,000 a year.
Okay.
Or your uncle had a farm that made $100,000 a year, I would, most cases, tell him not to incorporate the welding shop.
Okay.
Unless he felt the profitability was going to move substantially higher.
Okay.
On the farm, you got to look behind and see how much deferral is created. And they're tricking themselves with what's actually going on in the taxable income.
Okay. Okay, so that's a big difference.
The key recommendation is, obviously we'd love to work with all the farm folks at M&P, but realistically we're not going to. But really work with someone who understands agriculture and been involved for a long period of time, because they've had the experience, as I always say, to have, those of us have been in a long time, have had the luxury of screwing everything up.
You learn by experience.
Really learn from those mistakes.
Absolutely, and I know you guys are doing, Myers Norris Penny does a fantastic job in the industry. You guys are at all the trade shows. You have a wealth of knowledge within the team, so I do really recommend anybody out there, just go see a professional. As Dean said, whether it's Myers Norris Penny, make sure it's somebody that deals with agriculture, because it is so unique, like you said. And sit down, and that's really the best way, as he mentioned, to figure out what to do. Is incorporation right for my operation? You know, you can read all day, all night, and the good old Google can overwhelm you, but really myself, when we were looking at incorporating, that's what we did. We sat down with our professional and they went through it all. They were fantastic, and they said, absolutely, yes, you should be incorporated. So,
and if you go to 2 or 3 professionals, if you want to, they're not going to disagree. They'll have minor differences.
Okay.
There's not a fundamental mass. I mean, you look at incorporations, how many farms incorporate today versus 25 years ago. Before it was not commonplace, it is commonplace today. Okay. And if you're, what I recommend is you go seek that advice earlier rather than later, because if it is the right tool for you, it's a very powerful tool to let your farm grow and prosper substantially faster than it would be without it.
Wow. So really, age aside, operation size aside, income aside, just talk to a professional. And really, it's not going to take you a lot of time or money to figure it out. And as we reviewed in those numbers that you had crunched, that's a significant difference.
It is very, and everyone, one of the myths we hear lots of is don't put our land in our company.
Okay.
And if the land's paid for and everything's taken care of in previous generations, everything's been paid for and the land's all paid for, there's no automatic need. But in 95% of our farms, the land is being either transferred into the company or, I would argue, 100% of the farms being purchased inside the company.
Oh, really?
Because it's the ultimate utilization of a tax deferral.
Okay.
Because every dollar I put down in principal in a land payment is not deductible. Okay. Okay. And so in order to pay for land, corporate tool is the perfect weapon in your arsenal.
Okay, fantastic. You know, we've spent a good chunk of time here, and I feel like we've just scratched the surface, and I could sit here for a few more hours and pick your brain. I hope this isn't the last conversation we have, but I think that gives producers a great overview on incorporation. You know what? Don't try and guess. Don't avoid looking into this tool. It can have a significant impact on your operation. So if you're not sure, just go see a professional like Dean or anybody else out there that deals with agriculture, and in a quick hurry, they'll be able to tell you if incorporation is right for you or not. Thank you guys for joining us. Thank you, Dean. That was fantastic. And again, I hope this isn't our last conversation.
Thanks very much for having me.
Thank you.
You've been listening to Impact Farming. For more great episodes and articles designed to help you manage and grow your farming operation, head on over to farmmarketer.com. Don't forget to sign up while you're there. We will see you on the next episode.